Hi, everyone. Welcome to today's a16z crypto research seminar. Very happy to welcome Fahad Saleh, who's sort of has just seemingly infinite energy and has used an awful lot of it to do good work in the crypto space broadly. So very happy to host him today. And he'll be talking about something that's actually been on the mind of a lot of us here recently, which is value capture between L1s and L2s. So Fahad.
Well, thank you, Tim, and thank you for giving me the opportunity to hang out over here and the opportunity to present. It's been a lot of fun, and I'm hoping to get some good feedback here. Let me say I'm actually going to try to achieve two purposes through this presentation if it's not too ambitious. One is I do want to provide you sort of the perspective of a financial economist on whether L2s are beneficial to L1s, and that's the focus of the paper. Though one of the important pieces where I think sort of the economics comes in is that in the analysis I'm going to be showing you, I'm going to be thinking about things like total value locked endogenously, so based on economic principles. And so I also wanted to spend a little bit of time after I get through the introduction kind of talking about how economists more generally think about this, which will also sort of relate to the approach that's in the paper. So I guess one way of saying that is if you find the actual subject of my talk completely boring, maybe you'll get something useful out of it in terms of some background on the economics literature that you might find useful, for instance, for your own work. But please, ask questions throughout. I really prefer to engage rather than to turn this into a monologue. But okay, with that, let me dive in. So in this audience, I don't think I probably need to provide a lot of motivation, but I have the slides, so I'm just going to quickly go through them. So here I got the Ether price, and I got the ETH plus L2 TPS. I suppose TPS is probably not the metric this audience wants, but these are general purpose slides, so you'll have to bear with me. And so I'm showing it to you at 2 points, right? So one point is the day before the Deacon upgrade. And the other point is the day after sort of, I guess, the beginning of the vibe shift in the Ethereum community, when the EF sort of started putting out announcements about kind of prioritizing things like L1 scaling, right? And so this, I think, is reasonably stark, right? Which is that ETH prices before the Deacon upgrade were close to 4,000. You fast forward a little more than a year, and they're under 2,000, despite, frankly, I think the political environment actually being pretty good for crypto. And so Bitcoin was probably near all-time highs, for instance, at the second data point. So ETH prices collapse, but at the same time, the transaction activity in the Ethereum ecosystem goes up, which in some sense was kind of the point of the Deacon upgrade. So it's kind of like, I think more than anything, what I want to sort of draw out, which is probably familiar to this audience anyway, is that there is sort of a gap between Ethereum, the blockchain, and Ether, the asset, right? And certainly Ethereum more broadly conceived when you include the L2s, there's a gap there. And so it's not totally obvious, for instance, if you're scaling through these L2s successfully, that that's going to be good for the valuation of the asset Ether, right? So just in case people are worried about me picking 2 data points out, I'm showing you here the time series of actually here. This is Ether market value, valued in terms of Bitcoin. So essentially, I wanted to take out the crypto market factor, right? And this is not quite a line straight down, but it's pretty close to it. And again, this starts the day before the Deacon upgrade, and it goes up until the day before the Ethereum Foundation posted about sort of reprioritizing and making scaling the L1 kind of an important piece of that. So getting more to the paper, right? What I really want to emphasize here is the core economic channel in the economic model I'm going to show you right now, right? So I think the idea that, for instance, having blobs and thereby reducing transactions costs for data posting, that's going to accelerate transaction activity on the layer 2s. That's the point essentially, right? But the thing I want to emphasize is that if you are going to drive transaction activity onto the layer 2s, that's not the only thing you're going to drive to the layer 2s. Why is that? Well, think about the incentives of somebody to provide liquidity on layer 1, right? So for instance, what is the incentive for people to provide liquidity at Uniswap, right, on layer 1, right? If all the transaction activity is migrating to layer 2, there's going to be a natural shifting of the investment capital of the TVL also to layer 2, right? And so that actually is the part that I want to emphasize. So I think everybody sort of gets that sort of the things like the Deacon upgrade should shift transaction activity. But it seems to me the part that's missing in the conversation is what exactly that's going to do to the liquidity on layer 1 versus layer 2, and then what that might have to do to valuations of Ether. Now, one thing I want to point to here is that there's a very strong assumption in the model I'm going to be showing you with regard to the relationship between TVL and the value of Ether. And the reason that I'm going to make a very strong assumption about that is that I kind of think what we're assuming is more or less capturing the sort of the reality of the situation, but I don't really know how to think about the deeper forces underneath that, and so it's kind of hardwired in the model. So this is one of those points where actually I'd be curious to get feedback on, which is it seems to be the case that if you look at TVL on the layer 2s versus layer 1, a lot of that TVL on layer 2 is in terms of Ether, but it's less in terms of Ether than it would be on the layer 1, or than it is on the layer 1 rather, right? So for instance, like synthetics of Bitcoin, say Coinbase wrap Bitcoin on Base, seems to be relatively more popular than say wrap Bitcoin is on layer 1, right? And so if you envision a world where people hold Ether on the layer 2 to the same extent that they hold it on the layer 1, then probably you don't really have to worry about the kind of the channel that I'm describing here, at least to the extent that you care about Ether prices, because you could say, well, fine, the TVL will migrate to layer 2, but it'll still be basically all in Ether, and so the value will still be there for Ether, and essentially layer 1 becomes like a data posting layer or something like that, right? Nothing really going on in terms of let's say DeFi. But you don't necessarily have to worry about Ether prices collapsing in that context. But to me, that doesn't seem to be the case, right? Practically speaking, it does seem to be.
Quick question there. So, or should we think also of this as being like it seems very finance loaded. So if, for example, like 90, not that I think this is actually like a likely near-term outcome or maybe ever outcome, but if like 90% of use of all of these layer 2s and maybe of the Ethereum network itself was consumer application, something that sort of utilized Ether more as a medium of exchange than a store of value, like would we expect to see like a deviating story? Like it's not so much about like value is more derived from use value than TVL?
Yeah, so I think that you're kind of putting your finger on the most important thing here, and I don't know how to think about this, right? So basically what I'm saying is, to begin with, it's not even clear to me why the Ethereum, separate from the proof of stake mechanism and stuff, it's not clear why people need to be using Ether, for instance, for their main trading on Uniswap. Right. And it's not clear why they need to use it for payments or as opposed to any other token, even an ERC20 token that I might make up right now, right? So the only thing I can think of about asymmetries between layer 1 and layer 2 is that, Ether is born on layer 1 and it's a synthetic on layer 2. Bitcoin is born on the Bitcoin blockchain, is synthetic on layer 1 and synthetic on layer 2. And so one of the things I'd been thinking about is like, particularly given the sort of mainstream entrants who favoring Bitcoin, maybe when you push to the layer 2, you sort of create a situation where people...
Yeah, where the synthetics are substitutes for each other in a way that the native is not, the synthetic is not a substitute for the native on the native chain. Yep.
Yeah, so that's exactly, and they're not even perfect substitutes, right? Like my point is like Bitcoin actually has an advantage outside of this ecosystem, which maybe we see more on layer 2. And then there's another piece here that makes it even more complicated, which is Base doesn't have a native token yet, but correct, if they created one and they have Coinbase, that seems to be another problem. So I really think like you're putting your finger on the dial there, but the thing is I don't really know how to think about this, which is why I've kind of hardwired this idea that the TVL on layer 1 will be in Ether and on layer 2 less so. But to the extent that all of you have ways of thinking about it, I want to avoid things like totally trivial coordination effects, right? Like you can write a model where you sort of like nobody uses it, so nobody else uses it, kind of a thing.
Yeah, absolutely. Of course.
But I don't know how to think about that. And so in some sense, the more robust point that I'm going to be talking about here is about the TVL, right? Like that holds irrespective of the assumptions about kind of what people are using on these chains. And I will also say, like, I think there's a deeper question here that the Ethereum community doesn't take seriously enough, which is like, what is the value in the asset separate from the chain, Ether? And I don't have the answer to that. So anyway, the punchline is essentially that with this strong assumption here about the relation between TVL and Ether, that an increase in L2 activity can in fact reduce Ether prices. So just an overview of the paper, right? This is an economic framework, and what do I mean by an economic framework? Well, the really sort of, I suppose, big differentiator relative to maybe the way computer scientists think about things is that TVL, which is the investment capital, is going to be determined as a solution to the model. It's not going to be taken as given, okay? And it's going to be determined due to economic principles. Similarly, ETH prices will also be derived endogenously, although again, there's a bit of hardwiring around it, as I noted. Now, what do I co-authors and I really think the benefit of this kind of a framework is? Well, it very clearly highlights something that might be anyway readily apparent to many of you, but I don't think to everybody, which is that if you want Ethereum layer 1 to be more than just sort of a data posting layer, it is necessary to maintain non-trivial transaction activity, right? And in particular, how you do that specifically is the L1 has to remain sufficiently competitive relative to the layer 2, right? It doesn't have to be better, but it can't be neglected. And part of the reason I'm even framing it that way is that in some sense the Deacon upgrade, I mean, it was about improving the layer 2, right? It's the layer 1 sort of developers improving or helping the layer 2, right? They essentially were subsidizing the layer 2s, whereas they weren't really improving the layer 1 experience in what they did there. And to me, that's a bit weird, right? Like we have layer 2 developers doing things to improve the layer 2 directly. When Ethereum does an upgrade, I would hope that there are things in there that are sort of directly useful to people who want to directly use the layer 1, and I don't think that was the case in the Deacon upgrade. And so this paper is a bit pushing back against the idea that those should be the biggest priorities. And so again, this is not a negative L2 paper, right? So helping the L2s is perfectly fine, but that shouldn't be at the cost of improving the user experience on the layer 1. That's kind of the point, right? And so I will show you a formal result that will basically highlight this point about as long as the development of the layer 1 is not sufficiently far behind or is sufficiently close to the development of the layer 2, then everything will be fine. But if it falls too far behind, then everything won't be fine. And the channel, again, is what I was describing, which is sort of the TVL. So this is the Ethereum Foundation announcement. I'm sure you're all familiar with it, so I'm going to skip over it. I'll just point out that the first thing they did list was scaling the L1. They also had improving the UX as the third one, which I would say is also kind of additive. With that, before I sort of conclude the introduction, I do want to point to this post by Justin Drake. So incidentally, the entire idea of this paper came out from something that Tim organized, his CCE conference this year. I watched the panel, which I suppose initially had Justin against Dankert, essentially. I suppose I agree with Dankert, I guess is what I'm saying. So, let me just point here to those of you who don't know Justin's position on this. Let me just point to what he has to say here, right? He's saying 10K TPS on Ethereum, L1, 10 million TPS on Ethereum L2. Most of the activity will happen on L2s. Most people won't know they're using Ethereum. Ethereum's for everyone, believe in something. Now, the point I want to actually, he's obviously talking about, sometime in the future, but the thing that I want to fixate on is what he's describing as happening on the layer 1, right? So below the 10K TPS on Ethereum L1, he says high value transactions for all. So, it seems to be the thought process is somehow, it won't just be a database posting layer 1. The really, really high value stuff will happen there, and there's less of that stuff. So in raw numbers, there'll be less sort of transaction activity, but the high value stuff, that's what you want to do on layer 1. Now, the thing about this is if there's no liquidity on layer 1, and I'm taking that obviously as an extreme case, but just to get the intuition right. If there's no liquidity on layer 1, and let's forget about, the security through proof of stake having to do with market values of Ether, et cetera. Let's just take for given that layer 1 is 100% secure, bulletproof, but there is no liquidity. That means you don't have to worry about security, but even small trades will have essentially infinite costs. Who would trade on layer 1 in that situation, right? Like you need some liquidity on layer 1 for high value transactions to make sense on layer 1. And the high value and the liquidity is not going to live on layer 1 if there's not enough transaction activity, right? And so that step seems to be kind of missing as to what is the response of liquidity providers to what the Ethereum Foundation is doing in terms of scaling through blobs and so on. Yeah.
I think I agree with you, but Justin would say in response to this that like the high value transactions are actually going to be larger trades. And so even if there are fewer number of trades, like the total volume, which is really what matters for that spread equation. Well, I don't know if Justin would say that, but that's what I'll say is like
No,
there is
so-
a counter argument that these are going to be larger trades and therefore there's going to be more liquidity because they need to fill those, retail orders that are huge.
Perfect. Excellent. So as an economist, the way I'd frame it is you've described a trade-off, and it's not clear which way the trade-off goes. So I very much think of what I'm going to show you as, because partially, frankly, when I saw that argument, and I remember, Max, you got involved too, right? Like they had a few extra chairs and people sort of got on there. It's sort of, rather than kind of converging to a nice point, it kind of like got even more all over the place. And so as I was sitting there, I was thinking, wouldn't it be nice to have a mathematical framework to start to think through this? So I think it's a fair point, and the way I think about transactions here is relatively reduced form. It probably doesn't properly appreciate heterogeneities, which you're alluding to. But the way I would think about it is that it's not at all clear that the channel you're describing, which in fairness, I think you're saying like, let's think of the best counter argument. It's not at all clear that would be sufficient to get around what I'm describing. And I would love to either take feedback and augment the model in the direction that people in practice think is important to really get at the question. And I'd love to have other people pick it up and explore it too. But I think that, so let me put it this way. To Justin, I guess I would say, if that's the conjecture, I would love to see proof. Or another way of saying it, I have a model and he doesn't, right? So, okay. All right, so now let me yeah.
Can I ask another general question? So in the end, the layer 2s hinge on the layer 1s for security, right?
Yeah.
So
Yeah.
if the Ethereum price decreases, that means that security also decreases potentially. And
okay.
will it, like the model takes it into account, like the developers might move in response for that from the layer 2 to the layer 1 to sustain this security?
So, okay, there are a couple things I have to say about that. So there are externalities. So just because, so there's one world where you say the L2s are all good faith players and they actually would hate for ETH prices to crash to the floor because then proof of stake basically becomes insecure and the L2s become insecure. And so they would want to try to work to avoid that. But the fact that they might do that doesn't really make clear the mechanism by which that would actually happen, right? So there's one piece there in which I think, like particularly in the Ethereum community, they tend to take this sort of idea for granted. They'll say things like, look, Ether prices have to be high because it's securing a lot of stuff. But actually, it's exactly backwards. You write an equilibrium model, it's exactly backwards. What that sort of the reasoning would predict is that you will suddenly have a massive attack and everything will be worthless, right? And so there is a need to think about how you, if you believe that vision that you're sort of describing, where the L2s are all in good faith, that there is some way to actually capture value. And the current mechanism just doesn't have it. Now, I guess you could do things like offline, like you could literally have, I don't know, I guess L2 labs paying, buying Ether or something like that. I don't know. But there's nothing in the mechanism right now. And so there's, in that sense, there's nothing that is there to model, but the Ethereum Foundation should be thinking about this. The second thing I want to say about that, though, is, think about the incentives of Coinbase here. Is it obvious that they that they are invested in the long run vision of Ethereum? So one of the interesting things here is that it's very hard to beat a first mover. But what if the first mover helps you take part of their audience? Could you just basically become the new first mover? Like, okay, let's say you wake up tomorrow, and on Ethereum layer 1, the total TVL is 1 billion. And on Base, the total TVL is 150 billion, okay? And what if Base decides at that point, we don't want to be an L2. We will be even a centralized blockchain. And they say, yeah, okay, fine. You can trade on Ethereum with the 1 billion TVL, or you can come to us as a centralized chain, and you can trade through us. Now, I would argue that the success of something like Tether suggests that, at the end of the day, a lot of people are like, whatever, just give me the thing that works the best from the perspective of, let's say, transactions costs, et cetera, right? And so I don't know if you want to put yourself in that world. So it's not even clear to me. And that's another reason why I think, to the extent that people are going to make these arguments about about this value capture, you do have to find a way to embed it in the protocol. And in some sense, it gets back to what Scott was saying, which is, like, yeah, why do I really need Ether as a user? I get that if I use it, there's an externality to the security of the system, but I'm not just going to go buy a bunch of Ether in order to secure the chain because I don't have that much money anyway, right? Like that's a very odd reason to ask people to buy Ether, right? So yeah, it's kind of a long answer. Hopefully that got somewhere close to it. Okay, let me provide a little bit of sort of context on how economists broadly see thinking about things like endogenous investment, because I'm going to have to do this in the model. So I want to give you some background just broadly on the economics literature about it and about our particular choice in this paper about how to think about this. So there are essentially two approaches in the asset pricing literature, which is the main literature that this would be relevant, where this comes from. There are two approaches to think about how we think about endogenous investment decisions. One approach is called the general equilibrium approach. I'll tell you now, we're not going to use this approach, and I'll tell you why later. But essentially, the way the general equilibrium approach approaches things is it says, okay, look, there are a bunch of agents in the economy. They have preferences, particularly over their consumption, over what they eat, and they decide how much they want to consume and how much they want to invest in order to optimize their utility structure. So I'm giving you a very sort of simple static context. The thing I'm going to show you here doesn't depend on the static context. I can generalize it and has been generalized. This is just to kind of make the point. So there are a bunch of sort of hidden assumptions, which maybe I'll briefly point out, which is usually what economists do in this setting, although they don't always make these assumptions. They will assume that your utility structure is state separable and time separable. What does that mean? So I could say I have a general function that takes in my consumption today and my consumption tomorrow, but that's not what I'm saying. I'm saying I can decompose it into how I value the consumption today plus the expected value of the consumption tomorrow. This is a very common assumption. It's in almost all of the literature, but not 100% of it, right? So I have those state time separable preferences, but how is consumption determined? And this is where the investment part comes in, so imagine I have some income, and so I'm using Y for income, so Y0 is income today. That income is going to be allocated across consumption and investment. Okay, and I can have multiple assets here. It just would complicate what I'm talking about. But essentially, I have this consumption investment problem where with whatever I have, I'm going to split it between consumption and investment, right? Now, why would I forego some consumption today? Well, because tomorrow, whatever I have invested in will pay some return, and I can basically use that to consume tomorrow. So I can use essentially any asset as a mechanism to transfer value into the future, but it might be risky. So this R01 corresponds to the gross return on that investment, which it's a random variable, right? And I might have some new wealth, some new income tomorrow. Okay. So where would this approach go? Well, basically you say, well, I want to find the optimal amount of investment. So essentially, if the U is increasing and strictly concave and everything is well behaved, then it boils down to a first order condition. And so there's just a little bit of math here, right? So if you take a first order condition with respect to A0, you get the marginal utility today times times the effect on your consumption today of investing a bit more, which is -1, right? So every unit that I choose to invest is a unit that I don't consume, but I value it according to my utility, my marginal utility rather. And what do I get for it? Well, I get more consumption tomorrow, which I value according to my marginal utility tomorrow. And so it gives you an equation a little bit like this, which is really famous in asset pricing. And so there are a couple things that I want to highlight about this. So the first is, if you play with it a little bit, you can rewrite it the way I have here, which essentially what it then says is that the return on any investment, risk adjusted, must give you the risk-free rate. Okay? So what I'm saying is, you can think of this ratio of marginal utilities as a random variable and particularly as a pricing kernel. Okay? So I'm basically normalizing it, and that's what I call this Z thing. And so now I'm saying if I use this Z thing to price the return, I get back the risk-free rate, right? So that's a very general principle in asset pricing. And so this idea that returns are supposed to, once risk-adjusted, equalize, does come from something deeper than that, which is essentially agent optimization problems.
Maybe just comment?
Yeah.
It might help. I wonder if it's worth connecting this back to your motivating story. Like, who is it who's making an investment decision? What does investment mean? What does consumption mean? Back with respect to the L1-L2 story.
Right. So actually, that's a nice pivot to my next slide, because in some sense I'm going to punt on your question, but I'll tell you why I'm going to punt, because it's actually important. So this approach, which I'm calling the general equilibrium approach, is never used, as far as I know, in financial markets in practice. So I've worked as a quant and I've worked as a trader briefly. I never saw this in industry, and there are very, very good reasons why this doesn't show up in industry. So one is, what if investors are not rational? Maybe people are not taking first order conditions, right? Another piece is sort of assumptions about the utility functions and so on. But getting a little bit more to maybe where Tim was going. Even if you took everything I said as given, that investors are rational and they have state time separable preferences, what the hell are the utility functions? And more than that, what if we have different utility functions, right? There are aggregation results, I should say, and if anybody has heard the phrase representative agent, a lot of times what macroeconomists will say is that it's as if essentially there's one person and so there's only one utility function. And there are some theorems that tell you, like, given heterogeneities in the economy, how that would map to sort of a representative agent utility function. But I will tell you, like, personally, I never find those things very satisfying. And so ultimately, part of the point I want to make here is, so Tim was asking, well, like, who are the users, right? The truth is, this framework, I'm not sure it really helps you think about that to begin with, because it's making, in some sense, very strong assumptions, and so it's the truth of the matter is, like, exactly let's call it the microeconomic heterogeneities. I don't think there's a good way at getting at that. If you go talk to people who are sort of themselves, using these kinds of models, they will argue to you that the reason they're using these models is specifically because they do want to say something about the welfare of the underlying agents. But I think there are a lot of people, myself included, who think, this doesn't comport very well with the data. And that actually is frankly the reason why I'm not going to be using it here. Because one way to think about it is the scope of the paper is trying to think about an aggregate quantity, which is total value locked. And we can, for instance, find a way to model that effectively, which is in some sense without loss of generality to what's going on at the microeconomic level. If you model it this way, you then could say something about the microeconomic level, but then you have to take very seriously what you happen to assume about that microeconomic structure. And the difficulty I have with it is I don't think we have a good way of actually specifying the microeconomic structure in a credible way. Let me maybe I'm now reminding myself what I have on my slide. So this is actually a perfect next slide. So this, what I'm screenshotting here, is one of the most famous papers in economics, and certainly one of the most famous papers in equilibrium economics, right? General equilibrium economics. So you can see the title is The Equity Premium Puzzle. If you've ever heard of the equity premium puzzle, it comes from this paper. One of the co-authors on this paper, Ed Prescott, is a Nobel Prize winner. I'm just going to read you the first part of the abstract. Restrictions that a class of general equilibrium models place upon the average returns of equity and treasury bills are found to be strongly violated by the US data in the 1889 to 1978 period. This result is robust to model specification and measurement problems. What are they saying? They're saying we specified a general equilibrium model, we checked it against the S&P, it doesn't fit, and we're quite sure that's not because of other things like measurement problems, right? So this is kind of a classical paper, and as a graduate student, I found this to be the oddest thing because my thought was, like, if another graduate student had done the same exercise, his advisor would say, well, what do you think? You just specified a very unrealistic model. It didn't fit the data. Specify a realistic model. But it was Ed Prescott who was doing it, so it turned out it created an entire stream of literature trying to solve the so-called equity premium puzzle. And so the point here, though, is that these models, they do have the ability to provide us very useful qualitative insights. But if you really want to start talking practically, I don't think these are the sort of models you want to use. And then they're not used generally in practice for that reason.
That seems like a pretty large leap. So the reason we don't, you're saying the reason we don't want to use general equilibrium models to reason about, like classical GE models to reason about practical allocation, is because of the equity premium puzzle, right? That basically.
No, that's not what I meant. Sorry. No.
Okay.
No. I'm just using it as an example. So the point here is that most people don't have your economics background, so I'm just trying to provide some context on some of the struggles that I would say this is a fairly prominent class of models, the specific one, the CRA preferences that we're talking about here, right? But so I'm just trying to highlight because I think most of the room doesn't know anything about this literature, and I just want to clarify that there have been decades of struggles to try to get it to fit even sort of relatively simple data. And this is just to make that point. This is not supposed to generalize across like every single.
Okay, great.
Yeah,
Sorry.
yeah,
Go ahead.
yeah, fair enough. Okay. So now let me talk about the approach that I'm going to take. I'm going to take an approach which is sort of known as the no arbitrage approach. And essentially what this says is that if there's no arbitrage in the economy, then there exists a pricing kernel. There exists a risk adjustment. So you kind of get that random variable without having to specify sort of the underlying preferences. And what it really tells you then is that structure we were just talking about applies across a very large set of situations. And so you don't have to necessarily specify that stuff. One thing I do want to clarify is what I mean by no arbitrage. So the setup here essentially is that you tell me there are a bunch of assets, and so they're characterized by random returns, and you impose that there is no arbitrage in the sense that I cannot come up with a portfolio that is costless and then the sort of the random return of the portfolio is strictly positive with positive probability and weakly positive with probability 1. So essentially I'm saying I create a random portfolio, it costs me nothing, and I'm guaranteed to to never lose money, and sometimes I will strictly make money. So if you impose this, you can basically use sort of more technical results like whatever, the separating hyperplane theorem, to just say that there must be essentially this random variable. Anyway, we can't say sort of how it relates to utility functions and so on because we haven't specified anything, but nonetheless the pricing kernel still exists, right? And so if you really just care in some sense about thinking about sort of aggregate quantities, then this tends to be sort of a more useful way of going about it, right? One thing I tend to do in the paper is I tend to use what one stream of the literature, the quantitative finance stream, does, which is it sort of invokes this measure change. So you'll see this like Q superscript, right? So that's literally just a change of measure, and the change of measure is based on the normalized version of the pricing kernel. So if you care, kind of what I mean when I say this expected value with the Q, I literally am talking about changing measure with the normalized pricing kernel, as you see here. And the important thing is it gets you again back to where that GE thing had sort of left us off, which is at the very bottom of the slide here. You see it says that under this Q measure, the expected return of any asset must be 1 plus the risk-free rate, right? So risk-adjusted returns must give you the risk-free rate, it was where you get back to. So let me just kind of sort of summarize the differences. And again, I use no arbitrage in this model. So general equilibrium implies no arbitrage, because if you think about the sort of portfolio construction I described, it would imply, if it didn't hold, that the agent optimization problems were unbounded. So you wouldn't get a solution. So if you have a general equilibrium model, then no arbitrage does hold. And so one way of thinking about it is that it's just that that if you are committed to a certain general equilibrium structure, then I can tell you explicitly what this measure change is, and I can tell it to you in terms of the underlying preference structure. So the advantage of no arbitrage models, I don't have to specify risk preferences explicitly. The disadvantage is I can't talk about welfare. Right? So I'm not going to talk about welfare here because I can't, because I'm using a no arbitrage model. And just to give an analogy, I'm sure most of you have heard of the Black-Scholes model. If you look at the Black-Scholes model, right, at least the one that's sort of most famously known now, it doesn't say anything about the underlying microeconomic structure of the economy because it doesn't need to, because it relies basically on creating a synthetic call option and saying that that call option, or a synthetic derivative, and saying that the synthetic derivative must have the same price as the actual derivative, and that's no arbitrage. So let me get to the paper then, right? So as I said, it's going to rely on a no arbitrage framework. So I'm not going to make any explicit assumptions on investor preferences. Implicitly, what these models always assume is frictionlessness, which is to say that I can sort of scale up and down my portfolio without having any price impacts. That was assumed both in the general equilibrium setup and in the no arbitrage setup. That is one thing to keep in mind, though. For instance, like when we're studying, let's say, can I say shitcoin? When we're studying those sorts of things, you don't want to use these sorts of frameworks, because these frameworks are essentially assuming that you can scale up your positions without having price impacts. But anyway, I think for this setting it's probably okay. Now, when we talk about endogenous investment, what are the sort of relevant pieces of, what are the relevant investments in this setting? Well, specifically, what I'm going to be thinking about is dApp investment, both on layer 1 and layer 2, which are going to be competing with each other, okay? And I'm also going to be thinking about staking investment. To be honest, the staking investment is just there because it's supposed to be a proof of stake layer 1. It's kind of a sideshow to the model, at least in terms of the channel. But anyway, it is there. And I have a short-term risk-free bond also specified just because when you equate things to the risk-free rate, you have to specify the risk-free rate. But anyway, okay, let me keep going. Well, let me also just emphasize that the fact that these investments are modeled doesn't imply that there aren't other investments. It just doesn't matter. Okay. So how do we think about layer 1 dApp activity in this setting? Here, again, I think to Max's point through Justin earlier, it's a relatively kind of high-level approach to thinking about this. It basically uses kind of a construct from economics, which is like production functions, to kind of think of transaction activity as downstream of the investment capital, right? So the idea, for instance, is that the more investment capital there is on a layer, the more transaction activity it's going to generate. And this is kind of just using a familiar functional form to generate that. So we are sort of specifying specifically that the transaction activity on layer 1 between t and t plus 1 will have a particular form. And so there are three things on the right-hand side here that I want to sort of take a little bit of time to unpack. So first of all, we're assuming it's sensitive to both the TVL on layer 1 and the TVL on layer 2. Okay, I'm going to come back to that in a moment. But for now, all I want to say about that is the TVL is endogenous. It's something we have to derive, right? So if you're thinking about this more from a probabilistic perspective as to what is the guts of the model, what's driving the, what defines the probability space, it's not the TVL1 and the TVL2 because they have to be derived, okay? So what's going to be driving the probability space is two things, one of which is on this slide. And that one thing that's on the slide is this A1 process. What is the A1 process? Well, at an intuitive level, what I want you to think about it is I want you to think about, let's say, the quality of the technology directly. And so one way to think about what I'm framing here is imagine you wake up tomorrow and that Ethereum has all the same technology, both in terms of the design of the protocol and in terms of the specific smart contracts on the protocol, right? But there's no liquidity whatsoever on the chain, right? Now, my point is I think in that case, the total transaction value is probably going to be 0, right? Because even if you have excellent tech, which is the A is very high, the liquidity is not there, and so it makes no sense to trade, right? And so part of what this is supposed to capture is that transaction activity is not just a function of like how awesome the tech is. There probably are many blockchains out there that have very good technology but don't have any activity and therefore don't have a lot of liquidity and therefore don't have a lot of transaction activity. And so this is supposed to capture that by essentially specifying this multiplicative relationship, which again is the same relationship that we typically use for production functions. But then again, if you flip it around, right, and you say something like, well, what if there's a lot of TVL, but the technology isn't particularly good, right? Maybe gas fees are insanely high due to that. Then again, transaction activity shouldn't be particularly high. So we have the dependence both on the exogenous sort of quality, if you like, of the chain, the tech quality of the chain, and then also this dependence on the endogenous investment capital on the chain. So the usual assumption about this is that there's some concavity, and so we have that imposed here, which is that, in other words, investments produce, or the more and more you invest, you get sort of decreasing marginal returns, right? That's the beta 1 being between 0 and 1. The last thing I want to deal with is this TVL2, right? That's the TVL on the layer 2, okay? And now, what we're assuming here is that they are competitive with each other, okay? So we're assuming that the more TVL there is on layer 2, the less likely you are to trade on layer 1, all things equal. If you think that's not true, if you think that more activity on the layer 2 is going to cause more activity on the layer 1, then to be honest, you shouldn't really be concerned about this. Like the entire idea of layer 2 is actually is horribly unconcerning, I think, at that point. In terms of solving the model, we don't really need this assumption, but I kind of think it's true, and I don't actually know why anybody would care about, would be concerned about layer 2s if it wasn't true, and I don't know how to reconcile what we see in the data over the last year without this assumption. I just want to kind of be kind of upfront about that, because I think sometimes people sort of think I'm trying to hide this assumption. No, it's like I don't see why it would be such a big concern if you thought that like more activity on the layer 2 would then beget more activity on the layer 1. I think precisely that's probably not true. So it's sort of like a core assumption from the perspective of the worldview, I guess, of the authors. Although, you know, I'm happy to be disproved about this kind of assumption through the data, for instance. I just do think they are competitive with each other. Okay. Where do we go from here? So I've now specified transaction activity, right? And so the idea here is that the transaction activity translates to some revenue to liquidity providers. So some fee, you can think of it as like the transaction activity is transaction activity of trades at Uniswap, and there's some proportional fee, phi1, right? So this term is capturing sort of the return over and above your the capital, the sort of asset P&L, okay? And so whatever fees this is generating is shared pro rata by all of the investors, right? So that's why it's being divided by TVL1, but then you're holding risky crypto, and so there's some P&L due to that. I should say in the draft, we allow for you to invest in other assets, and it doesn't have to be just Ether. This is just really for simplification on the page. Really, so for instance, you can have wrap Bitcoin, et cetera, et cetera. You do need some investment in Ether. But the broader point that I want to make here is that when you think about specifying returns in this setting, it's not just about, for instance, the fees that I earn from providing liquidity at Uniswap. It's also about the fact that I have a risky portfolio position, and that's what the first part is capturing. Okay, and the prices will be determined endogenously, although, as I said, a little bit of hardwiring there. Okay, so actually, let me clarify. So here I've specified the return as a function of specifying the transaction activity. This is all I need essentially to sort of to apply the no arbitrage approach, because now I'm just going to basically say this thing risk adjusted has to give you the risk-free rate, and that's going to allow me to basically derive things like the total value locked and so on. So I'm going to move on to the next investment thing, which is staking. It's not really the focus of the paper, so I don't intend to spend too much time on it. The only thing I will say is that one of the places where I think the CS literature differs from finance literature particularly is a lot of times people tend to model the returns to staking as sort of exogenous, whereas there's a convention in the finance literature at this point to model it sort of as inflationary, which as it is, right? And so this is adopting that structure of making sure that it is inflationary in the model, right? So this is the return in terms of the Ether, but you have to multiply by that by the return on Ether, because if the price of Ether goes to 0, you actually get nothing, because 5 times 0 is 0, right? So this is the staking investment. It's just inflationary from the value of Ether. Now, in terms of determining pinning down the prices, well, this is just market clearing, okay? So what we're saying is if you stake, you have to hold Ether. If you invest in the dApp, you have to hold Ether. And again, in this case I showed you, they're actually investing fully in Ether, but in the paper, in the draft, it's a share. So it doesn't need it all to be like 100% in Ether. It could be 20% in Ether if you like. That'll be perfectly fine. But the more important point is there are sources of demand for holding Ether. One is staking, the other is dApp investment, okay? And that has to equate with market supply, and that's how I can induce and solve for a number of endogenous characteristics, including the amount of stake, the Ether price, and the TVL. Okay, so dApp investment on layer 2.
Sorry, M there is just the circulating supply or something? What is capital M? Okay.
So M is literally the number of Ether in circulation at time t. Okay, so L2 dApp investment is specified along the same functional form as L1 dApp investment. So again, transaction activity on layer 2 has this multiplicative form. It depends on, if you like, the tech on layer 2, which is this A2 process. So A2 and A1 are the two underlying stochastic processes that drive the whole model. Everything else is endogenous. Again, it depends on TVL on this layer in a concave way. So, sorry, it should be pointing there. It depends on TVL on the same layer in a concave way. It also depends on TVL on layer 1. We are agnostic about whether you think that this is going to be whether you think TVL on layer 1 will have a negative effect on layer 2 or vice versa. I've heard it argued both ways. I don't think the layer 1 and layer 2 are perfectly symmetric, which is why I could see, for instance, people using, like, for instance, all the people who were using Ethereum to begin with when the layer 2s weren't popular and the layer 2s became popular. It seems to me that, that there was a positive effect there. But, we don't need to take a position on this sign. So we're not going to. Some people do seem to have a strong feeling about it, so I'll let those people adjudicate it. So let me keep going here. So again, the L2 DApp returns. This is just sort of accounting at this point, right? Which is there's some transaction activity. Some of it is paid in fees. It's given pro rata to the people who are providing liquidity. And then there's some P&L. Now, so here, by the way, is like the really hard, strong assumption, which is to say, again, the version I'm showing you is a simplified version. In the draft, you can invest in other assets, but importantly, even in the draft, we don't allow you to invest in Ether when you're providing TVL on layer 2, which is supposed to be the hardwired, which is supposed to be capturing this thing that we were talking about at the start, which is for some reason it seems to be that people, when they do things on layer 2, they're less likely to use Ether. Right, and so this is really just a hardwired way of capturing that in an extreme case. The real question is, do you think that what we're seeing in the data right now is actually reflecting something deeper, or that we could live in a world where essentially people treat Ether on layer 2 the way they treat Ether on layer 1? If we could live in that kind of world, then probably the solution is like, well, let's figure out how to get to that world, and then we don't need to worry about this. But again, I actually don't know at all how to think about this. And so to the extent that you guys have thoughts on it, it would be very useful. Because right now I'm just kind of like saying, yeah, like the long run trend seems to be bad in the sense of, ETH usage on the layer 2s. I don't know why, but I'd like to know why, and then I'd be happy to put it in the model. But until I know why, I don't know what to put in the model. So, So again, I've now shown you basically the returns from these different things. And so as I said earlier, all I'm going to really do is I'm going to require that when you do a risk adjustment, you get 1 plus the risk-free rate, and the reasons for it is what I had said earlier in the part when I was talking about endogenous investment. So this is just the model solution. I won't bore you with the sort of the details of it. The only thing that I'm going to sort of emphasize is that, so I mentioned I don't specify risk preferences, and there's sometimes people get confused about this in that I am not saying that the risk preferences of investors do not have quantitative effects on things like investment. I am saying for the model solution I'm giving you, I can subsume that. And in fact, for the qualitative results I'm giving you, it doesn't matter. But it does have quantitative effects. And so I want to just take a moment to clarify that and to show you how, because particularly if you were taking this to data, you would see the quantitative effects show up. So this is the solution to the total value locked on either layer, right? And so everything on the right-hand side is exogenous. But one thing I want to fixate on is this mu star q thing, which is defined down here. Now, one thing that's important to realize is where risk preferences matter in any economic model is in pricing shocks. Okay? If you don't have any shocks in your model, then who cares about risk, right? So I told you there's like 2 stochastic processes driving everything. One is the A1 process and the other is the A2 process. These epsilons correspond to the innovations to those processes. So those are the only random things. And so the way risk aversion enters into this model is if you tell me that investors are more risk averse, what it implies is when I price these shocks, it's going to be lower. Okay? And the consequence of that is if you follow it through is if you were to tell me that investors are more risk averse, it implies quantitatively that this TVL is going to be lower. So there is a quantitative effect. It's not that it does not matter quantitatively how risk averse investors are. What the point of using no arbitrage here, for instance, is like you could literally sort of estimate the aggregate risk parameters rather than worrying about, what preference structure should I use for all of the agents in the economy. Okay, so risk does matter. It matters quantitatively, but it's subsumed by the solutions of the model that I'm giving you. This is endogenous staking and the market value. So everything is in closed form. Let me now sort of give you the punchline. So in the draft there are a few different results, but at the end of the day, it seemed like there was really one thing that was worth kind of talking about, or at least the one thing that we felt was the most important thing to talk about. And it relates to what I was sort of saying at the outset, which is, so first let me clarify this condition I have on the slide. So mu A1 corresponds to the drift of the log A1 process. So this is kind of getting at how much does the technology on layer 1 improve over time on average, okay? Mu A1 is, and the way I would think about it is think about this as the Ethereum Foundation's development efforts for the layer 1, specifically for the layer 1. So if they're doing things, sort of expanding blobs and so on, then it's not helping MU-A1. It doesn't mean MU-A1 is high. But to the extent that they're doing things specifically to improve the L1, that's MU-A1 high. To the extent that they're not doing things, it's MU-A1 low. Okay. MU-A2 is sort of the same thing for the layer 2, right? Although it can be affected by the Ethereum Foundation's efforts beyond sort of layer 2 developers, because of course, as we've said, the Ethereum Foundation Ethereum can do things on layer 1 that actually are essentially subsidizing layer 2. But the point is, MU-A2 captures kind of, if you like, how the tech on layer 2 evolves. And if MU-A2 is high, that means that the tech on layer 2 is evolving, positively, or very positively, whereas when it's low, it means it's not evolving quite as positively. And so the point is, you can take the ratio of these two things, and if it's below a particular threshold value, right, then it turns out you get kind of the horrible scenario that you don't want, right, which is the TVL goes to 0, point-wise, or almost surely, right, and the market value goes to 0. Now again, I want to emphasize, like, the TVL going to 0 is really the more robust result, and the second result is coming from this sort of hardwiring, which goes into thinking about, what assets you want to be holding on layer 2 and why. I do want to emphasize that the model assumption is that MU-A1 is positive, which is to say that the layer 1 is productive. Even if equation 5 holds, the layer 1 is productive. So in some sense, this is kind of like the saddest outcome, right? Which is that you have a technology that is fundamentally productive, but due to competition effects outside of it, it ends up basically becoming useless. And another thing I want to emphasize here is, notice this condition is about the ratio of MU-A1 and MU-A2, right? It's not about the absolute level, which goes back to the point of like what I was saying about, like, it does matter kind of how much development is happening on layer 1 relative to layer 2, right? These things are competing with each other for transaction activity. So again, the channel is fairly straightforward, right? So if the L1 is insufficiently productive relative to the L2, that is MU-A1 is sufficiently lower than MU-A2, right? Then transaction activity is going to migrate to layer 2. So the transaction activity on layer 1 in this case is actually going to go to 0, while the transaction activity on layer 2 is going to go to infinity, almost surely. And to some extent, we certainly you like the idea of the transaction activity on layer 2 going to infinity, but the more important point is kind of what happens to the TVLs. And the TVL, of course, follows the transaction activity. The TVL on layer 1 in this, will basically go to 0 almost surely, whereas the TVL on layer 2 will diverge, right? Again, there's a bit of hardwiring on this last step. And the market value will also collapse. It turns out that if you flip the condition I gave you, you get the exact opposite result, right? So if the same ratio I was describing is higher than that threshold, what happens? Well, everything is fine, right? That is to say that the TVL goes to infinity, the market value goes to infinity. And this is, I suppose, the rosy vision of layer 2 scaling, right? Which is that given that L1 is sufficiently productive relative to layer 2, which I'm noticing now I shouldn't have written, this statement about MU-A1 a lot greater than MU-A2 is wrong. I don't mean that, because in some sense there should be a constant here where MU-A1 can be smaller than MU-A2 still, but you know what I mean. Like if it's sufficiently close, if MU-A1 is sufficiently close to MU-A2, then both transaction activities will diverge, and both TVLs will diverge, and of course the market value will diverge, right? What I'm going to conclude with is, so I want to again clarify, this is not a paper that is negative about layer 2s. The point really was that when I saw that debate between Justin and Dankred, I really felt like some structure in the conversation could be useful. And so related to that, this is also not thought to be like a end-all paper. As I've said, there's a particular part of the model that I personally would like to improve but don't know how to improve it, because I don't really know, I haven't really figured out the underlying economic relationships and interactions well enough. And this is again how we should think about using Ether on layer 2 relative to using, say, synthetic Bitcoin on layer 2 as compared to layer 1. I still don't know how to think about that. And it's obviously important to thinking about what the long-run behavior of Ether prices are. But I do think this is sort of a properly formal way of showing that there is the possibility that layer 2s could be deleterious for layer 1s. Now, when you put that into the same context as that price graph of Ether that you all were probably already familiar with, right? And you put that into the context of the timing of this stuff, I think it becomes hard to say that, we should be completely on autopilot and just presume that if the L2s thrive, then the L1 will thrive and Ether prices will follow, et cetera, et cetera. Like even if you don't buy this story, then I have a question for you, which is like, how do you rationalize what we saw, right? And so I think, what the Ethereum Foundation is doing now in terms of like reorganizing and emphasizing the importance of scaling the layer 1 and so on is very useful. But it's not clear they've actually fixed the problem more than just sort of identified that they concede that there is a problem. And so I still think there's quite a lot of thinking to do related to some of the questions you all have had. And I'm hopeful this will be part of the conversation that can help us move forward. But again, I'm very happy to think about, enriching and improving the model, particularly along the dimensions of people who are sort of closer to the practice would think useful. And one last thing on the no arbitrage framework is that framework does, I think, take relatively well to the data. So one thing I have also thought about is that if people are interested on the empirical side, that is a direction that my co-authors and I could explore. With that said, I think I have about 3 minutes, so I will stop there.
My main issue with this approach would be the kind of hardwiring of TVL and the value of the underlying asset. I think that's like...
It's my main issue too, man.
I don't know. For me, it's like, what does TVL give you? 0 is my intuition there. I can't say.
So what do you mean by that?
Like, what does TVL in something that is not the native asset on the L1 or on the L2 give the holders of the token?
Oh yeah, and I agree with you. I agree. In fact, you could argue. So like, look, if you woke up tomorrow and all the ETH USDC liquidity pools were actually wrapped Bitcoin USDC pools, that's, even without the layer 2s, that's already a problem just for the coordination reason. So I totally agree with you. But this goes to like a deeper question that I think you've been touching on and Scott was touching on, and a few people have been touching on, is what the hell is the point of Ether to the user, right? We all get that there is security generated by the market value of Ether, but that isn't actually a useful reason for an individual person to hold Ether. Right? It's kind of like if you think that, I'm sure everybody would agree that the government can provide useful social services, even if you don't think some of the social services it provides actually are useful. I'm sure you think that there are some that it either does or could provide that is useful. That is not a reason for you to voluntarily pay a massive amount of taxes, because you're not going to yourself fund anything, right? So the idea that, oh yeah, look, but we all get that we need to prop up Ether is a really bad economic mechanism to solve this problem.
Okay, and then my second point would be, I think you talked about it, but it's not in the model, which is that the size of the L2s, the relative size of the L2s to each other matters a lot. So, for example, Base is doing like 120 TPS, Arbitrum 30, Optimism like 18 or something.
Yes.
And if they were all doing like 50, then that's a different story than if Base is doing 200 and everybody else is doing 1.
Yes, so I think I'm exactly on board with what you're saying. I do think that's a different point of inquiry. What you're getting at is sort of the market structure across L2s, which essentially, like we talk about, these systems are permissionless and so on, but that doesn't mean there's not market power owing to network effects, right? So if all the TPS is happening on one layer 2, that player has a lot of market power, even if you can create a layer 2 to compete with it, but nobody's going to use that layer 2, so they have market power, right? I think that's actually separately a very important question. It does dovetail a bit to this question in the sense that if you think about the incentives of a layer 2 that ends up in that position and is looking at Ether prices collapsing, now maybe it becomes very much like, yeah, why don't we just, essentially, become our own chain or something like that. But I would say it's a little bit beyond the scope of the current project.
I was just trying to understand the reason for the asymmetry between the layer 1 and layer 2 in the final conclusion. So is the reason due to 2 factors? The first one being that the externality of the L1 innovation is positive on L2, whereas it's the other way around. L2 innovation is negative on L1. And is the second factor that on L1, the return on investment is through like not only the fees, but also through staking, whereas on L2, it's only on fees? Is like, how would you quantify like the difference?
Yeah, so there are a number of asymmetries that are in the model. But I think the one, so for instance, like there's staking on layer 1 that's not on layer 2, but I think the one that's really driving what you're asking is not so much that it's about the cross interaction between layer 1 and layer 2 through the betas. And it's not specifically that we imposed anything about how the layer 2 responds to layer 1, but we did require that the layer 1 sees the layer 2 as competition. That hard restriction, plus essentially, if you think about the parameters themselves, they're sort of embedding the other side of that restriction. So to be clear, again, we're not saying our results do not really require that the other cross beta is also negative, right? They can both be negative, and our results are still true. But the point is the fact that we require that the effect of the layer 2 upon the layer 1 is negative, and are agnostic on the other effect. That's already kind of an asymmetry. And then it's just about like, yeah, if the mu A2 is sufficiently high relative to the mu A1, which is a symmetric effect, but applied in that context essentially generates this. There's sort of one equation I can show you that would probably completely clarify this, but it's very hard to communicate in words. I kind of need a pen and paper, but it's exactly that piece. It is the cross elasticities.
Early last year, there was this breakthrough in the Bitcoin ecosystem, which is called BitVM, and it will enable rollups on top of Bitcoin. So I was thinking it's interesting to see maybe the differences between rollups on top of Bitcoin and rollups on top of Ethereum. Because, for instance, rollups on top of Bitcoin will have a technological advantage. They're going to probably run EVM, so allow for quasi-Turing complete scripts and smart contracts and DeFi and so on.
Yep.
So they will probably, gain some traction. On the other hand, we have Bitcoin users, which most likely want to hold their Bitcoin. So maybe they're not going to transact Bitcoins on the layer 1, but they will have a reason to have Bitcoin in the first place. And I wonder if, this is going to be, in the light of what you showed today, if it's going to be a push for the Bitcoin community to increase the scripting capabilities of Bitcoin, to have more equilibrium on the technology side. I think it's going to be interesting to see how that's going to play out, because maybe there are going to be fewer transactions on Bitcoin and incentives change.
I agree that that's actually a very interesting point of inquiry. I think also in terms of what it's going to show us about what's going on here on the Ethereum community. And here's what I mean. Like the hidden elephant in the room is precisely Bitcoin synthetics, right? Like, so for instance, imagine Bitcoin synthetics didn't exist, right? Like imagine Bitcoin didn't exist and this world is happening. You know, what really are people doing on the layer 2s in that world when they're holding risky assets that are not Ether? Because right now it's not Arbitrum token that's really competing with Ether on Arbitrum. It's wrapped Bitcoin. And on Base, it's Coinbase wrapped Bitcoin. And the significance of Bitcoin there comes just from, Bitcoin being the OG and being kind of the thing that people who don't know anything about crypto think about when they think about crypto, right? And so, in fact, like in the Bitcoin context, I would be actually quite surprised if they had the same problem from their L2 succeeding. Because over there, like, what are the other, are people going to hold Ether, like a synthetic Ether over there? Like, I don't see that happening. I don't see why, like, native layer 2 tokens in that ecosystem. I'm conjecturing here, right? But my point is, like, one thing that is sort of the hidden elephant in the room is that there is sort of a network effect around Bitcoin. And that's a problem for Ethereum. But in the Bitcoin layer 2 context, it's not, right? In fact, it's supporting it in that context, right? So specifically because we don't see the native layer 2 tokens being very sort of successful in terms of becoming the main risk asset on their chain, if I were a Bitcoin maximalist, I wouldn't be that worried about proliferation of layer 2s in the Bitcoin community or in the Bitcoin ecosystem. But of course, that's just complete conjecture. Like clearly, I have a view on this that's beyond my model. But in some sense, that would test my theory, right? I guess.
All right. Thank you, Fahad.
Thank you.